Welcome to our three-part series of Financial Success with Sinikiwe Ngcobo, chartered accountant, financial wellness speaker and coach who saved over R500,000 in her 20s, paid off her first car in 3 years, built a 6-figure investment portfolio, and managed to take comfortable unpaid maternity leave to spend time with those who matter most, family. Take time to watch and be educated, encouraged, and entertained. Welcome back to my channel. As you guys have requested some financial wellness advice and knowledge, so I went and I found our beautiful lady, Sinikiwe Ngcobo, who is a financial wellness speaker and coach. Welcome.
Hey, thank you, Katlego, for having me. I'm happy to be here, guys.
Just give the people a bit of a background about yourself.
Okay, so I'm Sinikiwe Ngcobo. I'm a chartered accountant by profession, working in the financial services sector, mainly in banking. So what I do is financial wellness speaking and financial coaching, because I've seen that there's a gap in the market where people don't have the knowledge of like the financial products that are available and how to actually use them optimally in order to improve their financial wellness and personal finances. So that's where I'm at. That's what I do. I help people achieve their financial goals.
And she does that on a YouTube channel, so you guys should definitely check it out to get some more advice. And yeah,
I also have a YouTube channel, Sinikiwe Ngcobo. You'll find me where I share videos about different aspects of financial wellness. Yeah.
Thank you. Let's do it. So I got some questions from you guys, and I have a list of the questions. We're going to be going through them, and Sinikiwe will be answering them. And yeah, starting off is loans. So a lot of people, as we know, not everyone is privileged enough to buy a car or a house cash. So we go the loan route. So people wanted to know what should one do or know before getting a loan, whether car or home loan, to make sure they are financially successful.
Okay, so I would say that it's important to know how much capacity do you have, how much can you afford, because you don't want to find yourself going for your dream house or your dream car and it's actually not within your means at that point in time. Maybe it's like way too much. So just have a rough amount of this is exactly how much I want to pay every month and then work backwards, because a lot of people usually say, how much do I qualify for? Then they'll go to a bank and obviously they'll want to give you so that they can get as much as possible out of you every month. So it's important for you to know that your loan is about you. So you must be the one who's shopping for the loan and how much you are willing to spend, rather than the other way around where they are saying, no, you can afford more, because then you're going to end up biting on too much and then you have too much debt and then it becomes a mission to get out of as time goes on.
Is that the same principle when buying a car?
Definitely the same principle, because what they've done is there's something called a balloon payment or a residual. So this now means that when you buy a car, that basically means you can't really afford it, but to make you afford it, we're just going to defer a little bit up until the end as a residual or a balloon payment. So once you've paid these smaller installments, because what it happens is your installment becomes a little bit smaller because you've got this residual at the end of your loan term. But now come to the end of the loan term, you have to have this huge amount that you're not going to know where it comes from if you were not saving up for it while you were paying for this, which could have just meant you may as well have paid the higher installment, right? So because most of the time people can't even afford that residual, then now you have to refinance that. So it's now they say it's at the end of 5 years. So now you're having another year or two where you're now paying off that residual amount. So it's just debt on debt. So I wouldn't really advise that. So it's important to just know how much you can afford and not be duped by these terms that make things extra affordable.
And is there, like in terms of a home loan, for example, is there a rule of what's the best way to pay off your loan? Is there such?
Okay, so the best way is to obviously try to pay it off as soon as you can. So try to have a deposit, because that does reduce how much you're getting as a loan. So that you're not financing the full debt, but you've paid some of it up front. That really does help. And also whenever you can, just put in a little bit extra, and then depending on your financial institution, some of them don't allocate that against your capital. so it just stays there available for you to use. So so it's important to call your bank and just let them know how you want them to allocate that. Tell them that you wanted to reduce the capital so that it reduces your loan term, because some of them will just have it there as a facility for you, and then you end up doing a party, and then you're going there to get that money out. So it's important to kind of try to pay off your debt anytime sooner, because the earlier you pay, the less interest you have to pay on your debt. So I'd say with whether it's a car or a house, try to pay more than the minimum installment so that you can get out of that debt as soon as possible.
Okay, thank you very much. So that's it on the loans. If you perhaps have another question related to loans that we have not covered, be sure to leave it in the description. No, not the description, in the comment section, and we will make sure we answer it with the help of our speaker and coach. Moving on now to future. So people want to plan for their future and the future of their children.
Yeah.
So the question raised was, what is the best way to save for a minor, for a newborn, a 3-year-old, a child, basically?
Okay, so there's different methods of saving or investing, and it all depends on the time frame. So you need to see a financial advisor, make sure that they are registered with the FSCA. So you need to see a financial advisor and then work out like some of the products that are on offer. But I would say any investment product that you can get your hands on that is obviously that meets your risk appetite, it should be fine. And it all depends on how long you have, because you can't, let's say, save up for varsity for your newborn using something like a savings account that's just bearing minimum interest. You might want to maybe buy shares even, or something a little bit more aggressive. Whereas if your child is already 16 and they're going to varsity in 2 years, then you might need to put it into a fund or an investment that's a little bit more conservative, because you don't want to risk losing that money. So it really depends on your risk appetite and the horizon that you have, when it like as in the time horizon, how long you want to realize your money. But I would say any item, because it's important to know that sometimes we are so drawn to endowment policies. Oh, here's an education policy from this company, here's that. Sometimes those policies don't have the best returns and the best interest. So sometimes you can just say, you know what, I'm actually going to go for an aggressive unit trust, or I'm just going to go for shares. I'm going to buy shares or ETFs on the JSE, and that's what I'm going to fund for my child's education. So that's why it's important to allocate your money accordingly, so that you know that this fund, as much as it's a fund in your name, it's for your child's education. Because sometimes the main reason why you find that there's so many little financial products that are already packaged, education plan, retirement plan, this plan, it's mainly because we don't have the discipline ourselves to say these shares are specifically for education. Those ETFs are specifically for my retirement when I'm 50. But because we want to dip back into the cookie jar, that's what I call it, when you save, or you invest, and then you go back, and now you're taking it out. So now that these financial institutions have these funds where they'll say, okay, we'll lock it in for 5 years or for 10 years, it's mainly the discipline that we lack. But if you've gonna exercise your discipline muscle, then you can definitely have a portfolio that you can manage yourself, that you know that you're not gonna go and take the money out. So it's always a catch-22. If you know that you don't have the discipline, then by all means go the route where you are buying specifically tailored products to better make sure that your money is there for your kids when they need it. But if you've got the discipline, then you can do something that you can manage yourself, something that's a bit more aggressive, that has higher returns, because sometimes you also need to look at the fees. Sometimes there are high investment fees or financial advisor fees on some of these products that are already preset by these companies. So you just need to really be on the lookout in terms of how is your discipline, and then if you do have the discipline, then try to explore different means of saving or investing for your kids.
Okay. So you mentioned ETF. I don't know what's an ETF. I'm sure I'm not the only one.
Okay.
What is an ETF?
So an ETF is an exchange-traded fund. So similar to shares, it will be traded on something like the Johannesburg Stock Exchange or whatever stock market is there. So it's mainly the JSE. So it will mainly be different funds. So you'll find that one says we are tracking the S&P 500, or we're tracking the property companies in South Africa, or we're tracking global properties. So it's you no longer now investing in one company, but you're investing in more of a basket of companies. And if they're all doing well, then you get that trajectory. And if one of them is doing badly, it still kind of has a buffer, because now
from the
other companies. So that's one of the things that's nice about ETFs, is that it eliminates the risk, because it's not just one company that you're putting all your money in, but it's different companies.
Okay.
Yeah.
And the same method that you're saying to save for your child's education, would you advise the same for retirement? Because that's our next question. How should you prepare or save for retirement?
Yes, so for retirement, exactly similar concept. But what's really nice about the retirement is that SARS has given us the pension fund, something that's deductible, and there's also the retirement annuity fund, something that gives you a tax benefit if you invest in those funds. So what's important when you are saving for retirement is to first exhaust your limits for those non-taxable items, and there's also the tax-free savings account as well. So you want to first exhaust the tax-free or the ones that give you a tax benefit. Make sure that you're getting the maximum tax benefit before you move on to saying, okay, now I want to invest in crypto or something else when it comes to your retirement. So just make sure that the ones, because why those ones you're getting all those tax benefits is that those funds are already regulated. They already have minimum risks that they can take. There's a certain risk tolerance that they're supposed to have based on the age of whoever's contributing to the pension fund and how long it is that they still have before retirement. Whereas sometimes with these investments that we do on our own, we just like, I am buying cryptos, whereas maybe it's something that you can do now, but you can't do maybe when you're 59, because anything can now happen and you don't have the time to recover if you lose any of the money. So make sure that you maximize the pension fund at work. If you don't have a pension fund, have your own retirement annuity fund, because there you also get tax benefits, and then have a tax-free savings account, because even there, then your growth on whatever savings or investment you've done using the tax-free savings account, all of that is tax-free. So you do need to make sure that you maximize on all the items that you're going to get a tax benefit for.
Speaking on tax-free savings accounts, can you do the same for your child as for the education, for whatever, maybe the pursuit of their passions? Can you go that route? Would you advise a person to go that route?
So definitely you can do a tax-free savings account for your child. So what you can do is first try to maximize your own tax-free savings account, because everyone gets a lifetime limit. So the lifetime limit that you can invest into a tax-free savings account is currently 500,000, and the annual limit that you can invest is 36,000 per annum. So you need to first exhaust that before you say, I need to, because that 36,000 per annum can take you around 13 years for it to accumulate to 500,000. So maybe after that 13 years, then you can say, oh, well, maybe I want to have one for my child now. You can do that. But one thing to note is that it's everyone's lifetime. So your child, when they are older, they won't now get a fresh 500,000 when they are above 18. They'll still have that 500,000. So if you're contributing for them in their childhood, and then you use that money or withdraw it for whatever reason, they've lost out on that amount forever. They can't now say, it was my mom, I'm now an adult myself. So I'd always caution people against having a tax-free savings account on behalf of their child, unless you know that this is their inheritance and I'm leaving it specifically for them and it's going to grow. Because the longer you give any investment to grow, the better, and the higher the returns that you're going to get. You don't want to put money in and then you're taking it out after 2 years or 5 years, because then you're losing the benefit that you could have gotten, because once that contribution limit is gone, it's gone and you can't get it back.
And I think this speaks to the discipline that you're speaking about. You say, if you know that you're not disciplined, don't even go that route, because you might be jeopardizing something potentially good for your child.
Definitely, you don't want to do that. And I don't know how to explain, like, discipline is the main thing when it comes to finances, because it's what stops you from buying the t-shirt on your way home that you didn't need just because you saw it displayed on the window. So discipline is everything when it comes to finances, guys. Discipline, y'all. Yes.
Okay, now we're moving to how to grow your money.
Mm-hmm.
Are you feeling set up for your financial success? Join us for part 2 of Financial Success with Sinikiwe Ngcobo, where we discuss investment versus savings, investing low amounts, buying shares, business as an investment, and tax.